Hello world, my name is Rozara. I'm a full-stack web developer with a passion for investing. Now, before I start, first I'd like to thank my new subscribers. I've been doing this channel for about 2 weeks and I'm seeing very good growth. People are interested in this topic. People are gaining interest in this topic. People are texting me, messaging me, and asking me questions. So that makes me very happy that people are starting to invest and starting to become interested in this. And I'm having a positive effect on their life. Secondly, I'd like to talk about setting goals for yourself. If you have $30,000 invested, then you can get it to $60,000 by doing nothing in about 7 to 10 years. That's if you have it invested in an index fund or a diversified group of common stocks. 7 to 10 years is the average for you to double your money in the stock market. Now, setting a $60,000 goal for yourself would not be a good goal. I advise setting goals that are hard to achieve or slightly hard to achieve. They should be challenging at least. If you get a $3,000 check from work as like a bonus, a yearly bonus or something, take $10 or $20 and celebrate and put the rest of it into your brokerage account. Buy some more shares of more companies. Buy some shares of the companies that you already own. Maybe one of your companies is down 20%. Buy some more shares of that company. Don't get worried. Buy more shares. Buy another company that you're interested in. Buy another company that you've done some research on. It's very, very exciting, and I think everyone should choose to become wealthy. Choose to make the decisions that will enable you to eventually become wealthy. So, my first stock I have written on the board, MCD, stands for McDonald's. MCD is the ticker symbol, and you can buy this company right now for about $156 a share. The market cap is $124 billion, making this a large cap company. Currently, McDonald's pays out a dividend of 2.5%. That means for every $1,000 you have invested, they will give you $25. 2.5% of $1,000 is $25. So, last quarter they paid out 94 cents. Their earnings per share growth, according to Fidelity, is expected to be about 7%, although their revenue did decline a little bit in their last quarter. So that's something to consider. So let's just write that down, that they pay out about a 2.5% dividend yield. And their payout ratio is 66%, which means for every $100 that they earn, they give you $66 of it. And they use the rest of it for general growth and business operations. Okay, second stock on the list is Apple. Apple, we all know what that one does too. They sell cell phones. They run the iTunes store. AAPL. This is an enormous company. So let's see, you can buy a share of Apple for about $144, and the value of the total company is approximately $744 billion. This is the biggest company in the world right now. So their dividend yield is about 1.8%. So if every $1,000 invested, they would be paying you $18. Good deal. So their earnings are expected to grow by 18%. Last time they gave out a dividend, it was 63 cents, and they have a very low payout ratio of 29%. So for every $1,000 invested, for every $100 that they are earning, they will be paying you $29 of that. So Apple is a company that has a lot of cash on the books. I know that they have $84 billion of debt, but they actually have loads of cash overseas. So they can easily pay this dividend, and they can easily grow this dividend in the future. So third on the list, let's get right to it. I will go straight to Microsoft. I wrote this out of order, but I'll say Microsoft next because they're kind of a competitor to Apple. So why not mention them next? Okay? MSFT. Mr. Softy. So Microsoft pays a dividend of 2.3%. And I'm doing this one next just so we can kind of compare it to Apple, okay? So Microsoft, we can buy one share for about $69. It has a market cap of $529 billion, which is not quite as big as Apple, but it's still enormous. Microsoft is a very big company. Earnings are expected to grow by 10%. Let's see. Last time they paid a dividend, it was 39 cents. As I said, they're paying about 2.3% dividend yield, and their payout ratio is much higher than Apple at 69%. So they have a 69% dividend yield. They can still raise it, but that is kind of on the high side. So let's go down the list. Sherwin-Williams. Who knows what Sherwin-Williams does? Let's see. Let's do this in black. SHW. W. Sherwin-Williams sells paint to consumers, to businesses. Okay, Sherwin-Williams. Right now, one share is $352. Their share price has gone up a lot. So this company is much smaller than the ones I listed before. It's only $32 billion. But again, this is a company that's not going to go anywhere. Everyone needs paint. So Sherwin-Williams is paying out a 1% dividend yield. 1%. Okay. So last time they paid a dividend, it was 85 cents. And they have a payout ratio of 26%. So they have plenty of room to raise the dividends. They're only paying out 26%. That means they're using 74% for other business operations. So in my opinion, I think this is a very, very good company to invest in. This is one that I would recommend to my mom, and I think it has staying power. And I think it's not going anywhere. If you invest in this company over the 10 years that you own it, or more, if you want to keep it for 15 years or 20 years, I think you will do very, very well investing in this company. So their dividend is on the lower side compared to the other ones listed here, but they have plenty of room to grow that dividend. And I think this is a long-term winner. So I would give this one the thumbs up, Sherwin-Williams. Not necessarily giving my opinions on all the stocks, but this one I like. This one I like a lot. So Home Depot is next. Symbol for Home Depot, we'll do this in red. HD, Home Depot, and Home Depot pays out 2.3%. So you get $23 on 1,000 invested. Now, that might seem like a small amount of money, but trust me, when you have lots of companies in your Roth IRA, or you have lots of companies in your brokerage account, or your kid's 529 college plan, all these dividends coming in from all these different companies, it really adds up. This is a hell of a lot more than a savings account or a CD. You got companies coming in, if you got 10 companies, you got every quarter you have 10 companies that are paying you money. They're paying you money just to do nothing. It's so amazing. So Home Depot, they sell do-it-yourself hardware, hammers. I used to go to Home Depot and Lowe's every day. Actually, why don't I write down Lowe's at the same time? L-O-W. They're direct competitors. So Home Depot is trading for $152 a share right now, and Lowe's is about $77. Home Depot is a much bigger company, about 3 times as big. $182 billion for Home Depot. And Lowe's is, let's see, $65 billion. And with these lights, I am getting very, very hot. So let's see. They're both expected to grow around 13 or 14% in the coming year, grow earnings anyway. So Home Depot is paying out 89 cents and Lowe's is paying out 41 cents. So that makes Lowe's payout ratio approximately the same based on the share price right now. And that's 2.1%. So for every $1,000 invested, they would be giving you $21. So Lowe's and Home Depot, I would give these two a thumbs up too. I don't think they have too much competition with Amazon. I don't think Amazon is going to start taking away business selling lumber and heavy things like hammers that are expensive to ship. In my opinion, every time I go to a Home Depot or Lowe's, there's a lot of people there. And I think that's a very, very good sign. As I said before in my previous videos, I like to see revenue growth. I like to see earnings growth. I like to invest in companies that I use the products. And I've been to Home Depot and Lowe's a lot in my life. And they're always full. There's always a lot of people in line. And I think that's just a very good sign when you're going to invest in a company. And number 4, I like to invest in a company that's going to be here 10 years from now. I think all the companies on this list will definitely be here 10 years from now. So let's go on. Let's move on. Let's see. Number 7 and a bonus. I'll erase these. Number 7 is Nike. NKE. So Nike is a company that I made a lot of money with trading options, but I think it's a great stock to hold long term. My girlfriend owns it, I own it in one of my accounts, and my daughter owns shares of Nike too. So let's put it up on the board. NKE. Whoops. NKE. There we go. Nike is paying out a dividend yield of 1.3%. And a bonus, for comparison purposes, Under Armour, 0. Under Armour does not pay out a dividend right now. So, Nike, you can buy a share of Nike for $58. You can buy a share of Under Armour for about $19. Nike is a much bigger company at about $94 billion. This makes it a very large cap company. Under Armour might be considered a medium cap or a large cap. Under Armour, for comparison, is a $9 billion company, about 1/10 the size of Nike. So, Under Armour is definitely the underdog in this battle. So, Under Armour is expected to grow quicker at 23%. Nike is only expected to grow at 16%. I say only, but 16% is very, very good growth. So, especially for a company that big, 16% growth is good. So last time Nike paid out a dividend, they paid out 18 cents. The dividend yield is 1.3%, which is on the low side, but their payout ratio is only 29%. So, like some other companies on that previous list, they have plenty of room to grow the dividend. So, Nike, I would also give it a thumbs up. I own it for my daughter. I own it for myself. My girlfriend owns shares of Nike. And Under Armour, while it's the up-and-comer and it doesn't pay a dividend right now, maybe I wouldn't buy it for my Roth IRA, but I am planning on buying some shares for my other account, my regular brokerage account. And that's because I think Under Armour is just a very, very good company. And the market cap is much smaller, meaning it might have more room to grow in the future, in 10 or 20 years. It might be a much, much bigger company. I see a lot of people wearing Under Armour clothing. I do as well. And I know that they're getting into sneakers, so I know in a lot of ways they are a direct competitor to Nike. And they don't pay a dividend, but I'd probably give these two companies my blessings too. Under Armour used to trade for about $45, and now it's in the $19 to $20 range. So relative to where it was, it actually seems like it's kind of on sale right now. You can pick up shares for a discount. I don't think there's anything fundamentally wrong with the company. I know that Sports Authority and some other retailers are closing their doors. Sports Authority, I think, claimed bankruptcy, if I'm not mistaken. So the number of places that they had to sell clothing and shoes has decreased a little bit. But I think long-term, Under Armour is a winner. So maybe for your regular account, you can buy some shares of Under Armour, and for your Roth IRA, you can buy some shares of Nike. Something to consider. So let's keep on going. Next on the list, Starbucks. I made a video about Starbucks. Who knows the ticker symbol? SBUX. Paying a dividend of 1.7% and growing. Starbucks is growing its dividend. Starbucks is a $83 billion company trading for about $58 per share right now. I like this company. I don't particularly like Starbucks coffee, but I have been there a lot, so I am a customer of Starbucks. Sometimes you just have to go. Sometimes you just need a coffee. Anyway, Starbucks, as I said, the dividend yield is 1.7%. Last time they paid a dividend was about 25%, 25 cents that they gave you. And that was about a 50% payout ratio. So this company is expected to grow earnings by 15% according to Fidelity. I personally don't think they're going to grow earnings that fast, but that's what Fidelity thinks, and who am I to argue? Anyway, I can argue. I don't have to invest in them. I can invest in them. I have just as much of an opinion as anyone at Fidelity does. So I personally don't think they're going to grow earnings that fast. But that being said, I did buy shares of Starbucks for my daughter and for my girlfriend. So take it for what it's worth, and you got to make your own mind up when you buy stocks. You got to choose for yourself. Do some homework, and if the stock seems like a good fit for you, if you think they're going to grow earnings, that they're going to grow revenues, that they're going to be around in 10 years, and that you use their products, then it's probably a good stock for you to buy. So Starbucks, I don't know. It's a question mark. I did buy a couple of shares myself, and I made a video on it. I was a little bit undecided, but I ended up buying some shares. So next on the list, AMGN. I heard a rumor that if you invested $10,000 in Amgen 30 years ago, and you invested $10,000 in Apple 30 years ago, then you would have much more money from Amgen. From Apple, you would have about $3.4 million, and from Amgen, you would have about $9.8 million. So arguably, this has been the best stock to invest in, even better than Apple over the last 30 years. So I didn't verify those results myself. I heard it on CNBC, so you can look into that if you want. But it just seemed very like an amazing statistic to me. So I did buy 100 shares of Amgen for my girlfriend Rosie. They were trading at a relatively low PE ratio, around 14 or 15 times earnings. And currently, let's see what they're trading at, $171 per share, and they are a $126 billion company. They are one of the biggest biotech companies that you can invest in, and they have a very consistent stream of revenue coming in, all those pills that they're selling to people that need medications. It's a very consistent business, and I like it. They are paying out a dividend, let's see, of 2.7% right now. And these percentages, I want to add, are not fixed percentages. So companies like Amgen do raise their dividends over time. And a lot of companies that have already listed do raise their dividends over time. So Amgen gets my blessing. Let's see. Amgen is paying out 44% of their earnings as dividends and using 56% of their earnings for other stuff. Last time they paid a dividend was $1.15, and they are expected to grow earnings at 2%. So we will see how fast they grow earnings at. I own the stock. I bought the stock for Rosie, who owns the stock, and I'm going to be paying attention to it in the future. So this one obviously gets my blessing since I bought so much of it for my girlfriend. So next on the list, T. Rowe Price. This is one I bought a lot of for myself. I paid a little bit less than what it's trading for right now. T. Rowe Price is a financial services company. They offer mutual funds, index funds, that kind of stuff. And when I was younger, I used to own mutual funds through T. Rowe Price. So the reason why I invested in this company is because they have no debt at all, no long-term debt anyway, and they have been growing their dividends for over 25 years straight. So currently, right now, they pay out 3.1%, which is so far the highest payout that we've seen. The highest dividend yield that we've seen. So let's see. They are expected to grow at negative 1% earnings growth rate. I don't believe that. I think that they will grow earnings. I think people are being slightly cynical about this company for reasons that more people are taking their money out of mutual funds and putting them into index funds, which I think is a very good idea. But I think T. Rowe Price will figure out how to grow earnings in the future. So T. Rowe is currently paying out 45% of their earnings. They have a payout ratio of 45%. And last time they paid a dividend was 57 cents. So next on the list, Johnson & Johnson. The first time I bought this company was for my daughter. And this symbol is very easy to remember. J-N-J. Johnson & Johnson, trading at $132. This is a very big company, $357 billion. They are expected to grow earnings at 8%, and they have a dividend yield of 2.5%. 2.5%. Johnson & Johnson. So let's see, their pay ratio is a little on the high side, 56%, so they're only using 44% of their earnings for other business purposes. Expect to grow earnings by 8%. Last time they paid a dividend was 84 cents. So I bought 10 shares of this for my daughter. I think it's a long-term winner. I think it's definitely going to be around 10 years from now. The reason why I bought it for her is because she uses the shampoo. They make the baby shampoo that she uses, and I highly recommend buying companies when you use their products. Sometimes it's better to buy the companies than the products. So I got a few more companies on the list. If you want to stick with me, I'll keep on going. Next on the list, let's see. A company that I'm not so familiar with. MMM. Who knows what that company is? MMM. 3M. The company 3M. They make a lot of different stuff. They make a huge variety of different stuff. But I don't know much about this company myself. I threw it on this list hoping that someone that knows more about the company would teach me some stuff about this in the comments. I did notice the stock price was up very, very much over the last 10 years, and I noticed that they paid a very good dividend. So I threw it on the list and hoping that you guys could teach me. So let me just write down the dividend yield of 2.3%. Currently, you can buy one share of 3M for $209, give or take. It is trading, the market cap of the company, if you multiply the share price by the number of shares that they have, is $124 billion, expected to grow earnings at 7% next year. Last time they paid a dividend was $1.18, and currently they are paying out 57% of the money that they earn, their payout ratio. So we'll keep on going. Colgate-Palmolive, CL. CL. Colgate pays out 2.2%. Okay, Colgate. They make toothpaste and mouthwash and all kinds of different stuff that you can find in Walmart and other stores and Walgreens and CVS. Colgate is a very big company. So currently you can buy one share for $73. It's a $64 billion company. That's very big. Places them squarely in the large cap category. They're expected to grow earnings at 8%. Last time they paid a dividend, it was 40 cents. Like I said, the dividend yield is 2.2%, and they paid out, their payout ratio is 58%. So their payout ratio is a little bit on the high side, but they are growing. They are growing earnings, dividends, everything. Everything seems good. I don't know too much about this company. I don't own it myself, but it seems like a very good, safe stock to buy. We always need toothpaste, and I think Warren Buffett would say this is a very good, safe stock to buy. I don't know him personally, but that's my guess. So, next on the list, CVS. I made a lot of money with this one. CVS. This is a Rhode Island-based company, and I live in Rhode Island, so I like to invest in things that I know. I've been to many, many CVSs in my life. In Rhode Island, they seem to have a CVS on every corner. So, CVS is a direct competitor of Walgreens and Rite Aid. Most of their money, about 80% of their money, they sell in the pharmacy section, not in the retail section. So I don't think Amazon is a very big competitor for CVS, in my opinion. So you can buy one share for about $79. It's about an $81 billion company. They're expected to grow earnings at about 9%. So they pay out 2.5% dividend yield. So if you had $1,000 invested, they would give you about $25 a year. So last time they paid a dividend was 50 cents, and they currently have a payout ratio of 42%. Next on the list, PSA, Public Storage. PSA. This is a company that I thought about investing in 100 times throughout my life, but I never did because I always thought they were too expensive, and I probably should have. PSA has a dividend yield of 3.9%. I think we have a new leader on the dividend board. So, but the reason why Public Storage is paying out a 3.9 dividend yield is because their payout ratio is 114%, meaning that they paid out more money than they actually earned in the last 12 months. So that's not always a good sign. They are growing earnings, but I typically like to invest in companies that have maybe a 30% payout ratio. That way they have plenty of room to grow earnings. But Public Storage makes money from people storing their stuff. So to me, it seems like guaranteed income. People are always going to need to store stuff, and this company is going to be around 10 years from now because people always have a lot of stuff, and they don't want to get rid of it. They don't want to sell it. They don't have a place to put it. So Public Storage, the ticker is PSA. So currently, you can buy one share for $207. It's a $36 billion company. So it seems like all the companies that I wrote in this list are large cap. They are growing earnings by about 7%, or expected to grow earnings by about 7%. And last time they paid a dividend, it was for a full $2. So they're paying out a very hefty dividend. I don't know if I would recommend this stock because they are paying out more than they earn, but that seems to have always been the case as long as I can remember. So, or at least close to what they earn. So who knows? You can do your own homework and make a decision. So I have two more stocks on the list. Second to last, CLX, Clorox. Currently, you can buy one share of Clorox for $134. So if you have $1,000 invested, they have a dividend yield of 2.5%, so they would be giving you about $25. Currently, they have a payout ratio of 66%. They're paying up 2/3 of their earnings. But what they do have is a very, very good brand name. When you think of bleach, you think of Clorox. That's terrific. They have to be one of the top brands in the world. Everyone who knows bleach knows Clorox. So, it's a $17 billion company. They're expected to grow earnings by about 7%. Last time they paid a dividend was for 80 cents. Like I said, their payout ratio is 66%, so they are paying out most of their earnings as a dividend. And the last company they have on the list is a company that I recently saw on CNBC, Oracle. Oracle. The reason why I noticed this company is because they are getting so much more business from their cloud storage division. companies are just coming to them for data solutions. They want solutions to store all their databases and data that they have. And Oracle is really getting into that big time. This is a very big company. Currently, you can buy one share for $49, give or take. Last time I looked, I think it was $49 or $50. And it is a $202 billion company, so it's a very large cap. Their dividend yield is 1.6%. 1.6%. The payout ratio is 34%, so they have plenty of room to grow earnings. Last time they paid a dividend was 19 cents. They just raised it from 15 cents to 19 cents. So that is a very big raise. That's over 25% raise. And they're expected to grow earnings at 8%. But one reason why this company is so interesting is because of their cloud storage solutions. They are expected to grow earnings faster in the future than they have in the past. So I think this is a very interesting tech company to get into if you don't already own any tech companies. And the PE ratio is much, much less than if you want to invest in a company like Google or Facebook. Oracle is doing similar things as some of the other tech companies, especially Salesforce, CRM, which does not pay a dividend. But Salesforce is trading very, very high. And Oracle, in my opinion, might start growing at approximately the same rate as Salesforce. Not quite as fast, but for a much, much cheaper valuation. So thank you for listening to me babble on about these 17 dividend-paying companies and Under Armour, which I mentioned, honorable mention, to buy for one of your other accounts. And thank you for subscribing, thank you for listening, and please leave me some comments if you have any questions or ideas for the video. Thank you so much for listening. Bye.